everybody. Thank you for joining the conference call of Edge Invest Principia Fund. I'm Stefano Bestetti. I'm head of marketing of Edge Invest. I'm here in Milan with Alessandra Manuli, CEO of Edge Invest. In London, we have Marc Chapman, portfolio manager of Edge Invest Principia Fund, and Elisabetta Manuli, vice chairman of Edge Invest SGR. Please, Marc, go ahead. At the end of the conference call, we will have a Q&A time. So, but now, please, Marc, go ahead and give us your update about the portfolio, about your view. Thank you.
Okay. Hi, this is Elisabetta Manuli. I'm here with Marc in London. So the conference call today is going to be with, we will start with a few questions for Marc, and then anyone is free to join and ask questions as well. Hello, Marc. Hi. Principia Fund, I would say, is about roughly flat year to date, including these very difficult months for European markets that are down like 7-8%. And you got a very good performance in the first part of the year when the majority of the other European long-short equity managers were quite negative and experiencing a drawdown in the last few months. Can you explain how have you been changing the portfolio since May, adapting it to a more difficult European market scenario?
Yes, certainly. If we look at the full year 2014, we see a dichotomy between the first half and the second half. In the first half, I operated with a reasonably high gross exposure of more than 100%, the net exposure of between 20 and 30%, so to reflect that the conditions were reasonable for bottom-up stock picking. And in fact, the performance in the first half was driven by the individual good names in the portfolio, which performed well for stock-specific reasons. So companies such as Alstom in France, Soitec in France, and also Finac all performed well through delivery of a clear operating target, which meant good share price appreciation. Now, in the late spring, going into the summer, the indicators I use to track sentiment indicate to me that I should be reducing exposure. So as you know, I look at 5 or 6 indicators, some of which are qualitative and some of which are quantitative, and I've been doing this since 2005, and it's usually been quite accurate at avoiding large moves in the market on the downside. So in May, going to June, I reduced the gross exposure, reduced the net exposure, and adopted a more defensive stance, and even went slightly net short in that period. Moving into the summer, after the initial sell-off, I made one mistake, which was to increase some of our mid-cap names, which we liked, too early. And then subsequent geopolitical risk appeared with Russia, the Ukraine, the Middle East. And also some poor macro data compounded the problem and created a stronger downside scenario than we initially anticipated. Since then, we've been operating with a more contained gross exposure of between 70 and 90, and a net exposure of between 0 and 20 to reflect a more difficult circumstance. And that position, effectively, is to position the fund to take advantage of opportunity when it arises, so that we don't have to sell into weakness and deleverage when everyone else is deleveraging, is to provide some room to take opportunities to increase exposure when we see the chance.
And can you explain us in more detail the reasons of the drawdown that you experienced in the third quarter?
Yes, certainly. So the Q3 drawdown was essentially driven by 2 main components. The first one was a stock picking one, some errors on the stock picking side. And the second one was the deterioration in the macro data and the geopolitical risk, creating a deleveraging in Europe. So the first condition, the first point about stock picking. Because we're bottom-up stock pickers, we're in a relatively concentrated fund, it sometimes works very well and it sometimes goes negatively. And if you look at the four best and worst months of the history of the fund, you can see the volatility reflected in very good months when some of our stocks are doing well and negative months when they're doing badly. Unfortunately, in Q3, a few errors came together for no specific reason. It wasn't to do with a theme being played or to do with any macro risk we misunderstood. It was the fact that on some individual names, we miscalculated our assumptions about the midterm and then adjusted. So to be more specific, two names in particular, ASOS in the UK, which is an online apparel retailer, it's been a long-term growth case based on increases market share in the UK and then grown internationally. We thought there'd be some growth difficulties internationally, and those difficulties appeared in the spring when the company profit warned. The share price halved, and then we went to visit the company, and we thought that essentially the international pricing in the Asian markets and the European markets was going to take time to fix, but it adjusted expectations downwards. And also the operating leverage the company was going to show would be less than people thought. But now again, expectations have come down, and we thought that from the base level that we looked at it, they would start growing again quite well. And once they had their zonal pricing correct in the Asian markets, organic growth would be driven very strongly again. Now, we misunderstood how long it would take to get the pricing situation correct. They had to discount more than we thought in the third quarter, and so the results came out disappointing in terms of guidance for the subsequent year. And the share price fell aggressively during the third quarter. We reviewed our assumptions immediately, thought they were incorrect, and disposed of the position immediately. Second stock was Safilo in Italy, luxury goods eyewear retailer with its own brands and also a portfolio of third-party brands. Our case, based on a meeting we had with the company in Milan, was that their own brands would grow faster than their third-party brands and improve the EBITDA margin quite strongly through time. It reinvested free cash flow in emerging market expansion and create quite a good growth case. Unfortunately, in the third quarter, out of the blue, they lost Kering, which was a major third-party contract they had. They got compensated for the loss, but it removed a lot of the growth case. Again, we disposed of the shares immediately, but with a subsequent loss. Those two names were mistakes for stock-specific reasons, and they caused the drawdown. The rest of the drawdown was caused by mid-cap deleveraging in Europe and general selling. Now, we partially positioned the fund for this earlier in the year by reducing exposure, but the strength of the selling created a bit more downside to the fund in the third quarter, so we gave up the returns we had in the first half in the third quarter and ended up approximately flat for the year. So there's no specific theme at play which caused this. It's a natural function of the stock picking. It sometimes works very well. There's months which are plus 5%, plus 3, plus 4, and sometimes it works negatively. Over the long term, we've consistently added alpha through our stock picking on both long and short side. The long-term record of this fund and the previous hedge funds shows downside protection with a lot of alpha being added through individual stock picking. But on a short-term time frame, we can make mistakes and there can be volatility.
Now we are in Q4, and can you describe how is the portfolio current position?
So, looking at our indicators that we use to try to defend the funds during downside, obviously the third quarter wasn't fully defended because of the stock risk, but in terms of actual positioning, the positioning was roughly correct. But the individual names were disappointing in the third quarter. Now going into the fourth quarter, essentially we think that we've held growth exposure low so far, but the indicators we look at, such as the level of volatility, the put-call ratio, the sentiment in the financial press, the buy versus sell ratio, and stockbrokers we know, all of these indicate a bearish scenario. News flow is bearish in the financial markets. People are concerned about a recession. Volatility is raised. A lot of put buying. Now this creates the condition, we think, for us to increase our growth exposure again. What I try to avoid is a mismatch in stocks, a mismatch in longs and shorts, because in a bearish environment, it's bad to try and hedge just using puts. That can create a mismatch with the longs falling far more than you expect them to. And we avoided most of that mismatch. Now I'm looking to increase the growth exposure again, opportunistically, in names that I've seen in the past 3 months, where I think the valuation has fallen to more interesting levels, but also is a good structural case. So I'm not looking for a rebound in Europe in terms of economic growth or re-acceleration in global GDP. If Europe remains stable, the US keeps growing and Asia keeps growing, and conditions are below trend but okay, I'm looking for structural growth companies which have derated because they're listed in Europe, not because they're reliant on European growth. So to be more specific, Amadeus in Spain, which is a leading provider of airline IT, which is a huge market, $100 billion. They've been growing very well in the past few years through penetration of all of the airlines across the world based on their modular platform, which creates huge savings for the customers. Recently, they've been investing in hotel IT, which is not a large market, not as large as airline, but still large, which will create a long-term growth trajectory for the company, irrespective of economic conditions. So it's a very high-quality technology company with organic growth improving, high margins, good free cash flow, pays a good dividend yield, and also reinvests in the growth of the business, and has derated recently because of, one, airline worries, because of macro data and also Ebola, and also the fact that it's listed in Spain, but it's not exposed to the European or Spanish economy. It's linked to structural trends within the airline and travel industry, which won't change. The cost savings for hotels, cost savings for airlines, and reinvestment of these companies in a more efficient IT platform will benefit the world leader, Amadeus. And then Unibail in France, we've been increasing our exposure to, which is a leading operator of European shopping centres. Its focus is on large shopping centres throughout the European region. Now, in terms of the retail market, it's changing and fragmenting quite quickly. So what's happened is that there's revenue moving online as people shop online, and there's a shrinkage in terms of footfall in smaller shopping centres and on the high street. But all of the retailers, whether offline or online, all have to have a presence in the large malls, because that's basically where they advertise their full range of products, and that's where there's still growth in terms of footfall. Unibail are the best positioned company to exploit this. They've consistently outperformed the overall retail growth environment by increasing space in France and in Sweden, in areas where population densities and the net worth of the customers means that there's good potential growth. And consistently they rotate the brands, so bringing in new US brands which are more interesting, developing their food offering, developing their voucher offering, essentially offering a very good quality service which complements the online offering of the retailers. We think it should show good like-for-like growth in the next few years, even in a difficult European environment, good cash generation and a good dividend yield, and a structural growth, gradually disposing of smaller centres and reinvesting in the larger ones where the long-term growth will appear. And then Edenred in France, which is a leader in vouchers on behalf of companies throughout the world. The vouchers grow as the economy moves from a more black market to a more regulated market in South America. The government encourages use of vouchers so that they can actually regulate who's working. And then in general throughout the world, there's encouragement of the use of vouchers as a tax-saving mechanism on behalf of companies. Edenred is a leader in this marketplace, well-positioned throughout the world, benefiting from price inflation in Latin America. It's a long-term growth case, recently derated because of the depreciation of Latin American currencies, which provided a good entry point. I visited the company in France about 3 weeks ago, and I think the growth drivers are all intact. It's going to be new regions, growth in the customer base, growth in the spend per customer, and that's going to lead to a lot of operating leverage in the company. The margins can expand quite aggressively based on a relatively fixed cost base. So the examples I've given are companies which are listed in Europe but aren't particularly exposed to European growth. They just happen to be European in nature. The growth case is either structural because of IT investment or because of Latin American governments encouraging use of vouchers, in the case of Edenred, or in the case of Unibail, structural because the retail market is segmenting into online and large offline offerings, and everything else is being squeezed. So in these names, I'm looking for structural growth cases which have derated, where I think, in absolute terms, so compared to the company's return on capital employed or the company's free cash flow yield, they look attractive. At the moment, the long book shows about 50% upside over 2 years, which is, again, a metric I've tracked for a long time. That upside is an attractive number in absolute terms over 2 years. On the short side, there's less opportunities now because of the move down in Europe. So earlier in the year, we found some interesting short cases based on optimism towards the European region. So companies in France, like Legrand and Rexel, companies in Holland, like BAM Group and TNT, were all essentially discounting reasonable recovery in volume growth and in GDP growth in Europe. That's now completely receded. The expectations towards those companies are relatively low now. So bad data out of the European region is not a surprise on the European cyclicals. So rather we're focused on the short side on companies where we think expectations are still too high for 2015 because the market's overestimated maybe the growth component or some aspect of the case. So an example would be Novozymes in Denmark, which is a good quality company that we've known for a long time, world leader in enzyme production. The enzymes go into household products, so detergents for washing, and they also go into bioenergy, which is used as a blend in the gasoline market. Now, the bioenergy division has been driving growth this year because of a new product which is penetrating the customer base. From conversations with the company, I think that growth driver will slow down in 2015. And I think the household growth will remain quite subdued. So I think there's a risk that consensus expectations for 2015 and 16 are too optimistic given the strength of the growth drivers. It's still a good quality company. It's just that earnings expectations are a little bit too optimistic and the valuation is very high. So on those sort of occasions, we'll be short of those names. But in terms of general themes, there's no particular theme at play. Like I said earlier in the year, there was a theme to short some European cyclicals. That's now worked out. So looking forward, on the long side, I'm looking for structural long names which can drive return on capital employed mainly because of their own dynamics. And on the short side, any company in any sector where expectations are too high. Now, in terms of the general macro trends and the depreciation of the euro, we don't really invest thematically, so we don't think particularly about beneficiaries of that. It should help the export market. And if the euro collapses, and in an extreme case goes to parity with the dollar, then that will obviously be beneficial for the European region because there's deflationary pressures, so inflation isn't an issue. While on the other hand, the German exporters will obviously get a recovery from that. German exports in general have been affected this year by Asian competition and by the movement in the yen, and also the fact that the main international markets have weakened. So an example of VW, Brazil, China, Russia have been 3 growth markets for the past few years, which have grown in very well. 2 of those 3 have turned negative 2014. Brazil because of economic downturn, Russia because of the geopolitical situation. China's been okay. The weakness of the euro may help demand from a VW perspective in some of these new markets, and also if they stabilize, that can provide a backdrop for demand to start recovering. But I don't really anticipate a strong GDP recovery in Europe based on these factors, but nor does anyone else. Consensus is quite low now. People are bearish towards the region, bearish towards equities, big selling of ETFs, big deleveraging of mid-cap space in Europe, US investors pulling out the European space. This is quite a good environment for buying longs.
Thank you, Marc. We got some questions from our investors that I would like to make you now. Considering that long-short hedge fund investors expect hedge funds to follow markets upside performance, partially follow markets upside performance, and protect in case of market downside, do you expect to be able to deliver this type of performance in the following, I would say, 6 months to 1 year period?
Essentially, our track record at adding alpha on stock picking very good over the midterm. I'm confident that the strategy remains in place in terms of identifying interest in names which are misunderstood by the market and which will deliver improvements in earnings and return on capital through time. On the short side, like I said before, we're looking for companies where expectations are too high. The Q3 performance is negative for stock-specific reasons, and like I said, this happens now and then, but there's nothing to read into this in terms of the strategy. The strategy remains exactly the way it's always been, which is consistently delivered long-term returns of a good level. So I expect that to continue going forward.
So do you think to be able to deliver performance even in the case of these lateral slightly markets continuing in the future?
I think in a stable market, we should still be able to drive returns through the alpha in our long and short book. We think that there's significant upside on the longs that we have for stock-specific reasons, and we think that the conditions now are better for re-leveraging the portfolio. And so we anticipate when the macro risk recedes slightly, an increase in dispersion among the individual stocks, and that should drive returns. Essentially, during times of macro stress, the stock picking becomes less relevant for a while, but these periods don't last long. So the first half of this year was quite a good stock picking environment, even if the market doesn't do very much. If there's distress and deleveraging, then stock picking is put to the side for a while. And so in that situation, we try to be in a position where we have cash, because these situations don't last very long. When there's wholesale deleveraging, that's the opportunity to reinvest in the strong names. And then the next phase is dispersion rising again, which allows the alpha in the names to reappear.
September performance has been the worst since inception. And what would have been this performance without the two positions that you mentioned before, Stafilo and Atos?
The two mistakes would have accounted for approximately half of the loss in September. The other half would have been aggressive deleveraging of the mid-cap European space because of wholesale selling from US funds and from funds that have too much exposure. So in aggressive down moves, which don't remain completely intact, we can sometimes show slight downside, but in general, we try to make sure we're in a position to increase the exposure in the high conviction names to the point of maximum pain in the market. So when it looks like it's treacherous and difficult, volatility is high, market's nervous, we then try and add to our long names at that point. And this is what I've always done since 2006. The same stance, it's a slight contrarian stance, but always with a bottom-up stock picking view in mind. And this is over the midterm delivered good returns.
Okay, thank you a lot, Marc. I don't know if we have other questions from our investors.
Excuse me, this is the Chorus Call conference operator. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. To remove yourself from the question queue, please press star and two. We kindly ask to use handsets when asking questions. Anyone who has a question may press star and one at this time. Once again, if you wish to ask a question, please press star and one on your telephone. As a reminder, if you wish to register for a question, please press star and one on your telephone. Mr. Chapman, there are no questions registered at this time.
Okay, so I'll just make a few concluding remarks then. Obviously, the performance has been weak recently, and it's been weak for two specific reasons. Errors in the stock picking and a difficult market. Now, in terms of the errors, like I said, these happen periodically, but it doesn't mean a disturbance in the strategy. The strategy remains completely intact, bottom-up concentrated stock picking. So myself plus two analysts spend all of our time talking to companies and working out where the high conviction cases are. Over the long term, this has delivered good, low volatile returns with some periods of volatility. Now, those periods of volatility won't go away, but when they do, we try to make sure we're in a position to benefit from them. At the moment, we think with a relatively low growth exposure, a difficult environment, now is a good time to increase leverage. And so we look forward to increasing our overall exposure based on the opportunities that we see. In terms of themes or strategy, there is no error to read into the recent performance. It's just one-off and stock-specific in nature, and sometimes happens, and that's it. And in general now, I think it's a good opportunity to invest in Europe. It looks good from a bottom-up perspective. Valuation is attractive compared to anything else. The news flow now is bad, but that's the opportunity to enter the interesting names.
Perfect. Thank you, Marc. Thank you, Elisabetta.
Thanks.
Okay. Bye-bye.
Bye.
Bye, everybody. Bye-bye.